This video is called Company Lifespans Are Shrinking, Understand the Impact on the PE Ratio. So back in 2012, there was a study put out by a consulting firm called Innosight that looked at the long-term average company tenure on the S&P 500 and highlighted how it had been declining over time. And if you have shortened company lifespans, that should rationally imply lower PE multiples over time, simply because companies are not going to be around for as long as they used to be. Yet the market does not seem to have assimilated the reality of the declining lifespan trend, nor the sheer size of the competitive threat to S&P 500 incumbents from new startups. We think that at some point you reach a tipping point and we will witness a major reset of PE ratios that may feel like a black swan event when reality sets in, but it shouldn't because the trend is pretty clear today. And we will show some examples and then give some basic ideas on how to weatherproof your portfolio. So this is the graph from the Innosight study, which shows the average company lifespan on the S&P 500 index in years. So for example, in 1960, the average company would remain in the S&P index for about 55 years, and today it's down to about 20 years. You can see how that trend has declined over time. And so what's happening is that it's getting harder and harder to stay on top. Companies are not hanging on to their dominance as long as they used to. So we said if a company has a shorter lifespan than it used to, that should result in a lower valuation. In other words, a lower PE multiple, because you need to get your investment back in a shorter period of time before the company disappears. So we did an analysis of an expected PE ratio each year beginning in 1960 based upon a declining lifespan each year. We value a company like a depreciating asset with no residual value, using a lifespan of 30 years in 1960 and declining down to 18 in 2014. Using a variant of a valuation model we employ in our research, using discount and growth rates in place at the time, we generate a present value for a stream of earnings lasting for the life of the company, and dividing the present value by the earnings in year one to derive a lifespan adjusted PE ratio. We also calculate the PE ratio if we kept the lifespan constant at 30 years. The graph shows that the lifespan adjusted PE ratios should have declined from about 15 in 1960 down to around 12 today to account for this attrition effect in company lifespan. The red line shows the company lifespan on the right-hand scale, declining at 1% each year approximately. The blue line shows what the PE would be if the lifespan were constant at 30 years throughout the study. The dark green line shows the lifespan adjusted PE, and light green trend line shows the trend of that lifespan PE slowly declining over time. The actual PE is shown by the dashed line. So it's a slow grind down, but based on this reality, we do expect PE ratios to trend down over time. This chart from CB Insights is interesting. They put out some great data on new technology startups, and this is what they called unbundling of a bank, where they looked at Wells Fargo and show each of the different services that Wells Fargo offers, and then show all of the new upstart competitors and which particular service of Wells Fargo that they are attacking. And you can see it's just an unrelenting attack on every single service that Wells Fargo provides. It's just an unbelievable competitive threat. So what this means is that this rapid technological change is making the visibility into a company's future stream of earnings more unpredictable. It's hard to know if Wells Fargo is going to be able to maintain their market share and margins on all those products they offer. And this is interesting because it shows what has happened to the cost of launching a new tech startup. Back in 2000, it cost $5 million to launch a tech startup. But nowadays, with shared services like cloud, etc., and the ability to build a website so easily, in 2011, that was down to $5,000. So you can literally start a new venture today for a few $1,000s. Given the ease of entry, you will continue to see a lot more competition. If you think this is intense, it will probably get a lot more intense. And in just some examples, everyone is familiar with Kodak, a company that just did not see the winds of change coming. And then Hertz, the car rental company, got my attention today because the stock price dropped by 40% in one day on a bad earnings outlook. They have been coming under pressure from new ride-hailing or car-sharing services companies like Uber and Lyft because people no longer need to rent cars for business or pleasure when it's so much easier to get around with these new entrants. The technology that has come about has really eaten into Hertz's core business, and the car rental industry is really facing some tough challenges. This is exactly the kind of thing that might be considered a black swan event that seems to come as a surprise when the stock drops in half in one day, but shouldn't be, because this is something we know is happening if you pay attention to the startup scene. And so what can you do to protect your portfolio? Well, pay heed to Warren Buffett's insistence on having a protective moat. That is more important than ever. It's hard to evaluate the moat sometimes, but it's something you should think about. We say focus on companies that have a long-term moat or serve a basic need, for example, like residential real estate or food staples. Those are things that people will always need and are not likely to be innovated out of existence. There may be some innovation, but it may help those companies as opposed to putting them out of business. And so the key takeaway here is that business models are changing fast. Don't just assume that your favorite blue chip stocks will still be around in 15 years. And given that uncertainty means you should exercise caution with respect to paying too high a PE multiple. Don't assume that the so-called normal PE of 15 is okay, because a lot of these companies may not be around in 15 years. The stalwart of car manufacturing, Germany, just announced that they want to ban the internal combustion engine by 2030. That's in 14 years from now. So think about that for a minute. So focus on companies that have a sustainable moat or are less likely to be innovated away. Thanks.